Well, hello again. So, audit committee, really important, folks. Really, really important, both in the exam and in real life. Audit committee is basically all about independence. Okay, being independent, and what that helps in terms of the external audit, in terms of internal audit, in terms of how the company runs, basically. So, anyway, we're going to look at three different parts. And thinking about this independence, then it's not surprising that the members ideally are all non-executive directors, with one having recent relevant financial experience, because they're going to be dealing with the external auditor and with the accounts, etc. Okay, what's the objective then of the audit committee? Well, the idea is that it improves, it enhances public confidence because they are independent. It helps directors. It helps directors because of the expertise brought in by non-executive directors. Okay, they have this expertise, and so therefore one of them's got financial experience. It means that the directors will always keep up to date with the latest IFRSs, etc. If they've got any problems, they can go to them. Okay, also this independence. It's great for the external auditor. Okay, what I want you to think of is, here's the external auditor going to the board. So A to B, that's what could happen. The external auditor goes to the board and says, you're not doing this right, blah, blah, blah. And the board could just say, yeah, very good, I'm not listening. Or the auditor might not like doing it because it's the auditor gets paid by the board. And so what happens is the audit committee sits in here. So the auditor reports to the audit committee, and therefore they're not criticising the board directly. They can say, look, this needs doing, this is wrong, this is where things can be improved. And then the audit committee, being independent, can then go to the board and say, right, can we make sure that these are implemented correctly? So they sit nicely in between with this independence. Okay, so what is their role? Well, first of all, they need to monitor the financial statements, make sure that all IFRSs are applied correctly. They need to review the internal controls. They don't do that themselves, it's the internal audit department who does it. They check, they test all the internal controls, and then they report to the audit committee. So the audit committee, again, sitting like this, the internal audit, again, not going straight to the board, going to the audit committee, who can then make recommendations to the board. Okay, so internal controls are performed by the internal audit team. They then can review the internal audit team. They can review their assignments. The head of the internal audit department will report to the audit committee. They will also recommend the external auditor. They won't appoint the external auditor, remember that's the shareholders, but they will recommend the external auditor, and they can monitor the external auditor and make sure that the recommendations from the external auditor are carried out by the board. And finally, they do give an opportunity for whistleblowers. Whistleblowing, remember, is when you know that a fellow member of the company is committing some form of crime, normally fraud, and maybe you can't tell anybody, maybe you can't tell the board because it's somebody on the board, but by the audit committee being independent, then you will always have somebody to go to. So try and remember those 5 things, okay? And then finally, what I just want to quickly look at is the positives and negatives of an audit committee. We've kind of talked about them already, but the positive is obviously this independence. So you've got independent reporting, shareholders like that, great for the internal audit. The internal audit team can check the controls that the board have put in place, and then they can, instead of having to go to the board and criticise them, they can go to the audit committee. Similarly, for the external auditor, it's a lovely little bit of communication channel, okay, in between them and the board. So it's all about their independence, all about the fact that they allow this communication with the board. Okay, it helps directors, we said, because there will be people on there with expertise, particularly financial expertise as well, and of course the public confidence. Anything with independence in there, the public feel a lot more assured. Okay, the negatives could be the directors might not like it because it ends up being like a two-tier board system, where you have a main board and then you have a supporting board, and it could start to seem a bit like that, and they might not enjoy that. They want to feel that they have total responsibility, and they don't want to feel overseen, etc. Also, the NEDs might be overworked. You know, they're not there every day, and yet we're putting a lot of responsibility on them, aren't we? You know, the internal audit reports to them, external audit reports to them. They have to make sure the board carries things out. They have to help directors. It's a lot of work for one committee, so be careful that the NEDs aren't overworked because they're not there that often. And then, of course, as always, the time and the cost. Will the appropriately skilled NEDs, will they have the time to do all this work, and what will the cost to the company be? Okay, but generally there are far more positives than negatives to having all of that. Okay.